Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Arista Networks.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Right now, I feel like everyone in the market is just utterly obsessed with the AI chips, the actual.
Oh, absolutely. NVIDIA, AMD.
Yeah, the processors doing the actual thinking. But here is the reality of modern architecture. If those ultra-expensive chips cannot talk to each other flawlessly, you do not have a supercomputer.
Right. You just have a billion-dollar room full of space heaters.
Exactly. Just a giant, very expensive furnace. Today, we're doing a deep dive into the company actively building the central nervous system of the artificial intelligence boom, which is Arista Networks. And what makes this moment so critical for you listening right now is that we're looking at a massive, undeniable, fundamental growth story that has just experienced a pretty jarring post-earnings price drop.
Yeah, it's a fascinating divergence right now. I mean, the underlying architecture of the AI revolution is being cemented. Their financial growth is explosive. Yet the market has had this sudden, knee-jerk sentiment reaction.
Which scares a lot of people off.
It does. But it's creating a very specific structural setup for investors who are looking beyond the daily noise. It's about focusing on who is actually supplying the essential infrastructure for the next decade of tech.
All right, let's move into the wealth building context, because whenever you hear phrases like AI revolution or infrastructure build out, a cautious investor's radar should immediately flare up.
Oh, for sure. You have to be careful.
Right. You look back at historical tech build-outs like the massive fiber optic boom in the late 1990s, and you see these incredible euphoric hype cycles that eventually just collapsed.
Total implosions, yeah.
So the essential question for you listening is this. Do we view AI networking as a short-term speculative hype cycle driven by fear of missing out? Or is this a genuine long-term wealth compounder that deserves a foundational spot in a portfolio?
Well, the data strongly suggests this is a high-conviction compounder, and this recent dip is presenting a remarkably rare entry point. But to understand why it's a structural wealth builder, we have to clearly define the long-term play here.
Okay, what's the play?
We're talking about capturing explosive, sustained demand from hyperscalers. These are the massive tech giants, your Amazons, your Microsofts, your Googles. They are currently building out huge Ethernet-based AI fabrics.
Let's unpack that term for a second. Ethernet-based AI fabrics, because it's not how a traditional data center works, right?
No, not at all.
In a normal cloud environment, you might have thousands of servers, but they are generally handling independent tasks. One server loads a web page, another streams a video. But AI training is entirely different, isn't it?
Completely different. AI training requires massive parallel processing. So you might have a cluster of 10,000, 20,000, or even 100,000 graphics processing units, GPUs, that all have to work together as a single unified brain to train a large language model.
Wow, 100,000 GPUs.
Yeah. And they are constantly sharing billions of parameters back and forth. If the network connecting them is even slightly slow, those extremely expensive GPUs just sit idle, waiting for data.
Which is what they call a processing bottleneck, right?
Exactly, a processing bottleneck. And Arista provides the high-speed Ethernet switches that wire all of those processors together so they can communicate at the speed of light. They aren't just selling plumbing, They were providing the central nervous system that allows the AI brain to function.
That's a huge distinction.
It is. That is a foundational shift in how computing is done, not just some passing software trend.
The central nervous system is the perfect way to look at it, because if the nerves fail, the muscle can't move. But a great technological concept still has to translate into financial reality. Now let's look at the fundamentals, because if we are going to classify this as a multi-year compounder, the math needs to aggressively back it up.
And it absolutely does. I mean, the revenue trajectory right now is accelerating at a pace that significantly outshines Arista's own historical averages. In the first quarter of 2026, revenue hit $2.709 billion.
Mhm.
That is a 35.1% year-over-year increase.
That's massive at that scale.
Right, and it's highly profitable growth, too.
Yeah.
Their adjusted earnings per share rose 32% to $0.87.
Sustaining 35% top-line growth at a multi-billion-dollar scale is incredibly difficult. But looking at the segment breakdown, the AI networking division is where the true velocity is, right?
Oh, without a doubt. Management just raised their 2026 AI revenue target from $3.25 billion to $3.5 billion.
But wait, there is one metric buried in the report that is far more impressive to me than the 35% revenue growth. And that's that actual product shipments grew by a massive 54% year over year.
Yes, that is the most critical number in the entire earnings report.
And we should explain why there is such a massive gap between 35% recognized revenue and 54% shipment growth. It comes down to deferred revenue, doesn't it?
Exactly.
Because in the enterprise hardware space, you can physically ship $1 million worth of equipment to a data center. But until the customer fully installs it, tests it, and formally signs off on the acceptance criteria, the accountants cannot legally recognize that money on the income statement.
Precisely. So the hardware has left the building. It is sitting in a hyperscaler's facility. But the revenue is temporarily deferred. So when you see shipments growing at 54%, that is the true real-time indicator of underlying demand.
It's basically a coiled spring.
Yeah, it's explosive hardware movement that will inevitably convert into recognized revenue in the coming quarters.
And beyond the growth, the financial health of the business is structured like an absolute fortress. For anyone focused on downside risk mitigation, their balance sheet is just pristine. They carry zero debt.
Zero, which is wild.
Right. In an era where the cost of capital is a massive burden for tech companies, having zero debt is an incredible strategic weapon. They are a pure cash generation machine. They posted a record first quarter operating cash flow of $1.69 billion. And looking at the full year 2025, they had a net income of $3.51 billion with a net income margin of over 38%.
The margins are just staggering.
Their free cash flow margins hit an astonishing 47.2%.
Think about that. When nearly 50 cents of every dollar coming in the door turns into free cash flow, it consistently covers all organic research and development needs, and it leaves a massive surplus for opportunistic share repurchases. That is the literal definition of compounding shareholder returns.
It is, but let's introduce some critical pushback here.
Okay, let's hear it.
When a company operates with profit margins that over 38% net margins, you are essentially painting a giant neon target on your own back. Economics 101 says that massive margins attract massive competition.
Sure, of course they do.
So what is functionally stopping legacy giants like Cisco, who have practically unlimited global resources, or current AI kings like NVIDIA, who sell their own networking gear, from just aggressively undercutting prices, storming the market, and eating Arista's market share?
It comes down to a highly protective, competitive moat, and it is rooted entirely in software. Arista isn't just selling metal boxes with cables. The magic is their software-led approach, specifically their extensible operating system, known as EOS, and their cloud vision management software.
How does an operating system protect them from a giant like Cisco?
It creates architectural consistency. So imagine you are a network engineer managing a massive global infrastructure. Arista's EOS runs exactly the same way in the deepest core of your AI data center as it does out on the campus edge, where employees connect to the Wi-Fi.
So it's all one unified system.
Right. It is one universal language. If you want to switch to Cisco to save a few dollars on hardware, you have to rip out that entire unified operating system, retrain your engineering staff, and risk catastrophic downtime.
Oh, wow. Yeah, that sounds like a nightmare.
It is. In AI, if your network stalls, your 10,000 GPU cluster stalls, the switching costs are prohibitively dangerous. It's simply not worth the risk for these customers to change vendors.
Okay, architectural consistency defends against Cisco, but what about NVIDIA? Because NVIDIA actively bundles their proprietary networking standard, InfiniBand, with their highly coveted AI chips. That is an enormous leverage point.
It is leverage, definitely. But the market is actively pushing back against it. Arista is winning the connectivity shift because they champion open Ethernet standards. They have incredibly deep co-engineering relationships with the hyperscalers and frontier AI labs.
And they don't want to be locked in, I assume.
Exactly. These massive customers who are spending billions do not want to be locked into NVIDIA's proprietary closed-loop networking ecosystem. They want the flexibility of open Ethernet, and Arista delivers the absolute highest performance in that open standard.
Makes sense.
Plus, their strategy is already expanding. Arista's scale across business, which provides the heavy-duty routing that connects these massive, geographically distributed data centers to one another, is approaching a $1.2 billion run rate. Just 12 months ago, that specific business segment was practically at zero.
Going from zero to a $1.2 billion run rate in 12 months proves they're executing right now. But the stock market is relentlessly forward-looking, you know. Investors want to know what happens next. That brings us to the catalyst timeline. What are the specific milestones on the calendar we need to be watching?
The immediate event horizon is their upcoming earnings call on August 4th, 2026. This will be their Q2 report. The baseline consensus expectation the market wants to see is $2.8 billion in quarterly revenue.
Okay, $2.8 billion.
But more importantly, the market will be looking for management to confirm that the delayed revenue we discussed earlier is converting. They need to show they are tracking flawlessly toward that $3.5 billion annual AI revenue target.
Looking at my notes, the metric I am going to be laser focused on that day is gross margin. The forward guidance management gave us between 62% and 63%.
Yeah, that's a huge one.
For you listening, this is arguably the most critical metric for the entire investment thesis. If Arista can hold their gross margins at or above 62%, it completely dismantles the core bearish argument.
Exactly.
Because the bears believe increased competition will eventually force Arista into a price war, causing structural margin compression.
Oh.
If margins hold steady in August, it proves the recent stock sell-off was purely an emotional reaction to expectations, not a fundamental deterioration of their pricing power.
Spot on. And zooming out from just that single earnings date, we have to look at the sheer scale of the macro tailwinds acting as catalysts throughout the rest of the year. The hyperscalers, again, Amazon, Microsoft, Google, Meta, are collectively projected to spend over $710 billion on capital expenditures in 2026. $710 billion.
That number is almost hard to comprehend. And to be clear, capital expenditure or CapEx isn't just software development or payroll. That is physical money being spent on hard assets.
Exactly.
They are buying real estate, power grids, cooling systems, processors, and critical networking gear to physically construct the foundation of the next iteration of the internet.
It's an unprecedented infrastructure build. As the year progresses and the market starts aggressively separating the actual profitable AI winners from the speculative pretenders, you're going to see a massive rotation. Defensive growth capital is going to flow heavily back into measurable, high-margin AI winners like Arista, who are capturing a direct slice of that $710 billion pie.
Now let's pivot to the chart. Because the fundamentals are pristine, the defensive mode is deep, and the future tailwinds sound fantastic. But the technical reality on the screen right now is undeniably ugly.
It's pretty red.
The stock is currently down 22% from its all-time high, following a severe post-earnings sentiment shock. If you are logging into your brokerage account and seeing a 22% drawdown on a premier AI infrastructure stock, it feels like momentum is fundamentally breaking.
Well, if you look at it in isolation, yes. But I look at that chart and I see a deeply bullish reframe. You absolutely haven't contextualized the timeline of that 22% drop. You cannot ignore what happened right before it.
Which was a massive run-up.
A historic run-up. Heading into that earnings report, the stock had rocketed 41% in the month of April alone. It was up 56% over the trailing 12 months. When a stock runs that hot, that fast, the market price is in absolute perfection.
So the underlying mechanics of the drop were driven by elevated expectations, not poor performance. I mean, management delivered a beat and raise. They beat the revenue estimates and raised future targets. But because it wasn't the astronomical blowout numbers Wall Street whisper numbers demanded, algorithmic selling triggered.
Precisely. A 22% pullback after a parabolic 41% one-month sprint is not a structural breakdown of the company. It is a highly necessary, perfectly healthy correction from severely overbought levels. For momentum-focused investors, this is what is known as a textbook higher-low reset opportunity.
Getting back to a reasonable baseline.
Right. The froth has been cleared out, and the base has been reset at a much more sustainable level for the next leg up.
So what does market sentiment look like? Because a 22% haircut is significant no matter how you slice it. Are the major institutions hitting the panic button and distributing their shares, or are they stepping in?
The institutional mood is overwhelmingly constructive. First, on an industry level, Arista was just named a leader in the 2026 Gartner Magic Quadrant for Enterprise Wired and Wireless LAN.
And for context, the Gartner Magic Quadrant isn't just a vanity award. It is the gold standard matrix that chief information officers use to justify multi-million-dollar vendor purchases to their corporate boards.
It's huge for enterprise sales.
Right. It plots companies based on their completeness of vision and their ability to execute. Being named a leader there actively accelerates enterprise sales, proving Arista is winning far beyond the data center and successfully invading the everyday corporate campus space.
Exactly. It validates their total addressable market expansion. And on the equity side, despite that 22% price drop, a staggering 93% of covering analysts continue to rate the stock a buy or strong buy.
93%. That's incredible.
Yeah, they are uniformly framing this current dip as an accumulation event. We are seeing major upgrades for 2026 that demonstrate massive institutional conviction. Rosenblatt just raised their price target to $210. JP Morgan went to $200. Evercore ISI reaffirmed at $200. Morningstar raised their fair value estimate to $190, and Raymond James just initiated coverage with an outperform rating and a $164 target.
So the smart money is not running for the exits.
Not at all.
Okay, the institutional math is clearly bullish. But I was looking into the speculative whispers on Wall Street, and there is a massive rumor driving some of the undercurrents right now regarding Arista's mysterious large new customer. Have you seen this?
Oh, the Google rumor. Yeah.
Exactly. The street is heavily theorizing that Alphabet's Google is this new client. Google just unveiled its new Virgo network, which is their custom AI data center fabric. If you look at the technical specifications for the Virgo network, the bandwidth and routing requirements perfectly match the capabilities of Arista's brand new 7800 series hardware.
It's a perfect match.
If that rumor proves true, securing Google as a massive anchor client for their highest margin next-generation gear is a phenomenal catalyst that isn't fully priced in yet.
It would be a monumental validation of their open Ethernet strategy against proprietary systems. It's definitely a catalyst to watch closely.
But as we always do, we must flip the coin. Now let's talk about the risks. Because no matter how perfect the narrative seems, a bear case always exists. And for Arista, the primary friction points are valuation and execution risk.
Right. It's not a cheap stock.
Even after bleeding off 22% of its share price, Arista still trades at a steep premium. We are looking at a 28.82 times next 12 months enterprise value to EBITDA multiple. Let's break that down for a second.
Go for it.
Enterprise value is essentially the true price tag of the entire business market cap plus debt minus cash. EBITDA is the raw core cash profit the business generates. So at 28.82 times, investors are willingly paying nearly $29 for every $1 of core profit Arista generates. To put that in perspective, Cisco trades at just 18.20 times.
The massive difference.
When you command a premium multiple that high, it leaves absolutely zero room for execution errors. It is priced for flawless execution, and we saw Citi actually cut its price target on Arista precisely because of this execution risk.
It's true that it is a premium multiple, but you have to pay for growth. That premium is justified by their trajectory. Arista boasts a 27.1% three-year revenue compound annual growth rate.
Which Cisco doesn't have.
Exactly. That $3.5 billion AI revenue target represents a level of hyperscale penetration that peers like Cisco simply cannot match right now. I would argue that the severe 22% post-earnings drop already absorbed most dangerous valuation risk. The multiple has been forcefully reset to a much more digestible, realistic level.
Fair point on the multiple reset. But let's look at their physical operations, because there are some flashing warning signs in the supply chain. Arista is facing major supply constraints, specifically dealing with 52-week lead times on certain critical products.
Which is a long time.
A full year. Customers have to order their hardware a full year in advance. Furthermore, there are reports of Broadcom chip decommits. A decommit means the supplier Broadcom, who manufactures the internal silicon for these switches, tells Arista they cannot deliver the promised components on time and pushes the delivery to the next quarter.
Right.
That physically caps Arista's upside. You cannot recognize revenue on a product you cannot physically build.
Supply chain friction is always frustrating, yes. But in the context of the AI boom, I view this as a high-class problem.
Wait. How is the physical inability to manufacture enough product a high-class problem?
Because it unequivocally proves immense inelastic demand. If lead times stretch to 52 weeks, it means massive enterprises are perfectly willing to lock in capital and wait a year just to get Arista's specific technology, rather than walking across the street and buying a readily available alternative from a competitor today.
Ah, I see.
That dynamic is actively building a massive, highly visible deferred revenue backlog. It essentially guarantees future revenue acceleration once the supply chain bottlenecks inevitably ease. The demand is not evaporating or going to a competitor, it is simply being pushed slightly to the right on the calendar.
Okay, I see the logic there. The revenue is delayed by the supply chain, but it is not destroyed by competition.
Exactly.
So with everything on the table, what's the final verdict?
The final verdict, based on the data, is a bullish score of 8 out of 10. Arista Networks has solidified itself as the definitive pick-and-shovel AI back-end networking play. Their software-defined architecture, their unyielding moat around architectural consistency, and their leadership in open Ethernet put them in a prime position to capture a massive share of the $710 billion capex spending from hyperscalers. The fundamental financial floor here is incredibly strong.
And what is the proper investment horizon for a setup like this? We've clearly established the volatility makes it a difficult short-term trading setup.
Exactly. This requires a multi-year hold perspective. We are looking at a firm 18 to 24-month horizon. That extended timeline is critical for two reasons. First, it gives the market ample time to watch the full maturation of these 2026 AI fabric deployments translate from deferred shipments into actual recognized revenue.
And the second reason?
Second, holding through 2027 allows an investor to fully capture the upcoming XPO product cycle ramp.
Right, the transition to the next generation high-speed optics that use lower power but double the bandwidth. It seems the risk-to-reward ratio has improved dramatically after this recent sentiment-driven pullback, provided they successfully defend those gross margins in August.
Absolutely.
But it does leave you with one lingering, provocative thought to consider. If Arista has already successfully conquered the deepest, most complex back-end AI data centers in the world, the next logical question is, when do they start aggressively coming for the massive front-end corporate enterprise space that legacy giants have monopolized for decades? Keep an eye on that transition.
Definitely something to watch.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.